Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 2nd of October, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are my market observations this week. ASX 200 is trading around 8,208. This is up 0.74% from last week. Well, this is good. The market's continuing to trend up, although today it's a little weak. Iron ore prices are soaring. This is great for Australia, great for our economy. It's up from the low 90s. Aussie dollar right now, 0.6883. To me, this is a vote of confidence for the strength of our economy. Here's a chart that shocked me. The first one is 2008, and look at the blue on the right. That was China's participation in the global market for solar power. Now look at 2024. China is blue again, and it controls the market. This again, China domination of clean energy. Shocking. In all the different categories, China is black. This is real scary in terms of the global supply and demand for clean energy solutions. Price of oil. Well, we've all seen the price go up in the supermarket. This is a price chart. It's pretty shocking. However, it is coming down a little bit. Don't expect it to drop in the supermarket anytime soon, though. There's always a lag. This chart shows the performance of Australian real estate investment trusts. It's fascinating, worth taking a look at. And this chart's important because it shows you most of the hybrid issues and what their current yields are. Three companies today. The first one is Rio Tinto, code RIO. It's trading around $125 a share. This 5-year chart shows it's been a seesaw. Right now it has soared because the price of iron ore has gone up off its lows. And you can see on the right the sharp upward movement. However, with every upward movement, it subsequently declines. So the key with Rio is, how do you trade these ups and downs? Well, first, let's look at the numbers. These estimates are from Barrenjoey. The market cap right now is over $200 billion for Rio. Barrenjoey has a price target of $133. The revenue growth from 2024 to 2026 is only 1.5% per annum. And that's because analysts, ever since 2020, have been expecting iron ore prices to get weak. They get weak short term, but then turns around, China does a stimulus, and iron ore goes back up. That is what's happening today. So even though Barrenjoey and other analysts say Rio has very slow revenue growth rates, I take it with a grain of salt. It's important to have something to look at, but bear in mind, it truly is off of the price of iron ore. Earnings per share growth in the same period, Barrenjoey is estimating at 3.8% per annum, and they showed dividend growth at 5.5%. Now, because these numbers are pretty mediocre, I figured, let's take a look at what shareholder equity growth rates are. And this is surprising. It's positive. It's at 9.8%. I like that. What it shows is that Rio, even though it's kind of stagnating, it is a very well-run company, and the growth rate in equity is still much greater than the bond yield. In fact, it's more than twice the bond yield, plus you get a good dividend. Now, the PE on the 2026 earnings estimate of $12.62, now this is Aussie dollars, is only 10 times. Historically, mining companies like this, 10 times is about right. It is highly cyclical, and so you discount it for the risk of getting a down cycle. The yield on the 2026 dividend estimate of $7.93 is 6.3%. This is attractive and keeps the stock price up. Free cash flow is 9.5%, which is excellent, and a payout ratio of 60%, which means 40% of their earnings are retaining for future growth or potential dividends. As you know, Rio is a major iron ore producer and copper miner. They have a huge mine, Samandu, in Africa, which is coming on board, which will help their growth. However, again, it's up to the price of iron ore. I view it an excellent company, but because of the unknown certainty of the underlying commodities, I rate it a buy, but I would definitely sell call options as a hedge to get extra yield out of it. By buying the shares and selling calls, you can get over a 10% income while having less market risk. Second company today is Brickworks, code BKW. It's trading around $28.95. This is a 5-year chart also. And you can see that it's been an upward trend for quite some time. Yes, it has come down off its peak, but don't count Brickworks out. It is a long-term performer. On numbers, Jardine Estimates is showing a 12-month price target of $30. The market cap is over $4 billion. The revenue growth they have for the 2024 to 27 period is only 5.4%. The earnings growth in this period is 21% per annum, and the dividend growth is estimated at 2.9% per annum. Shareholder equity growth is only 3%. The PE ratio on the 2026 earnings estimate of $1.47 is 19.7 times. This is kind of in line with the market for companies like this. The yield estimate for 2026 on an estimate dividend of 71 cents is 2.5%. Free cash flow is close to 4% and the payout ratio 50%. Brickworks, by name you can guess, manufactures clay building products and has a land bank and property trust for industrial sites. I like Brickworks, always have. It's boring, but it has delivered for shareholders. It is really a property play. The land bank is property that they hold that they can develop into industrial sites. This is attractive. And then they also have a property trust where they own property and they rent it out and earn income. Right now I rate it a neutral. However, keep your eye on it because if it starts to improve the fundamentals, I would definitely increase to a buy. Third company today is Codan. Code on the ASX is CDA. It's trading at $16.33. This is an interesting chart because it's U-shape. Before COVID, it was soaring, then COVID, it tanked, and now it's coming back. So what's the future for it? Let's look at the numbers again. These estimates are by Canaccord. The market cap is almost $3 billion at $2.8 billion, and they have a 12-month price target of $16.76. Now, I looked at a lot of the institutional brokers that cover Codan, and I averaged their price targets. It came in at around 16.8. So I chose Canaccord because they're right in the middle of all the brokers. Revenue growth rate they show is 12.9% per annum, which is excellent. The earnings per share growth from 2024 to 2026 is 18.7%, and the dividend growth in this period is 16.9%. These are all very strong, positive numbers. And the shareholder equity growth rate is 11%. So on the surface, this company is a winner. The PE on the 2026 earnings estimate of 66 cents is 24 times. Well, with those growth rates and a PE of 24, this is still a buy in my book. The yield on the 2026 dividend estimate of 31 cents is only 1.9%, but that's okay. Company with these growth rates, that is fine. They don't have to pay a big dividend. Free cash flow is 5% and the payout is 50%. So what does Codan do? They're a technology company making electronic equipment and instruments. The debt on their balance sheet is not material. That's what NM stands for. Organic growth and acquisitions is what drives the company. I rate it a buy. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Have a great week, and I hope you're profitable. Thank you.